What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Nextera Energy, ticker NEE, because the stock is down nearly 9% today. And the main reason for this is pretty much because interest rates are high and that it's costing them a lot of money to fund their projects. So that is the main reason for the drop. Now, what this company does is they are a renewable energy company that operates mainly in Florida. And so, as you can see here, it says it involves the generation, transmission, distribution, and sale of electric energy in Florida. So, if we get started and look at their revenue, we are going to see that it's somewhat consistent at about growing at only about 4% per year. So, in last year they did nearly $21 billion. So they are a pretty big company, and the revenue growth is consistent, but it's not a lot. So I still give that a check though. Then we get to net income. I put a no because it's flat. Last year they did only $3 billion of net income, and that's, if we look at the last 10 years, that's pretty much what they were doing like 10 years ago. Was they were doing 2.5 billion in 2014. So there's not really much growth there. It's pretty much been decreasing. Then we go to the price to earnings, and on a forward basis, they're trading at 16 times this year's projected earnings. Okay. But on a trailing basis, they're looking at about 13 times earnings. And here's the chart for the last 4 years or so. And as you can see, it traded at around a 28 for a while. And then it's kind of been, for the last year and a half, it's kind of been decreasing now. And it was as high, it came from a 39 all the way down to a 12 now. So this is pretty cheap. I would think that it wouldn't fall too much more than where it's at now. Even if we go further back, it has been as low as an 8 and a 9. So that is possible. So you got to keep that in mind. But at the same time, I feel like that's an extreme case. Most of the time it was around a 15, a 20, and then in this period it was trading at 30 times earnings all the way up to 110. So this is pretty cheap. It could fall a little bit more. It could fall another 5 or 10%. I can see that happening. But 8 times earnings, that would be the most extreme scenario, and I don't think that would last very long. So that is the P ratio. I would still consider that cheap. Definitely, it's definitely on the cheaper side of things. Are they innovative? Yes. I put for green energy, for their drones with AI, and for different battery storage. If we go on their website, they talk about some of these things like renewable energy, innovative technologies, green hydrogen. Here they say they're exploring new technologies with state-of-the-art renewable energy solutions, leading-edge battery storage systems, to smart grid technology, and drones equipped with AI. So I would say they are, for the space they're in, I would consider them innovative. Strong market share. This one was kind of tough because it's sometimes it's hard to judge what is considered strong market share. Like, obviously, if we're talking like some spaces, like if we're talking about the pop industry and Coke and Pepsi, it's fair to say that they have strong market share, right? For the airline industry, you could say that there's definitely more players in that space, but you could say United Airlines, American Airlines, Delta, Southwest, those are the big players, even though the market share is going to be less. In this case, we're looking at their biggest market shares in the solar power industry, and it's about 11% market share. So that's not a giant number, right? Because in some spaces like Coke and Pepsi, they might have 40% plus of the market share. And so in that case, the numbers are going to be bigger. In this case, I would say 11% is a significant number for market share. In the other spaces, that maybe it's only 5% or 7%. But I mean, when you're talking about a space this big, it makes sense that 11% would be considered a significant market share. Return on invested capital. This is probably one of the biggest downsides to my analysis here. The stock is only having ROIs of 3%. And to me, this is one of the most important things to look for in a stock. And not only that, but as you can see here, in the last 25 years, it's been decreasing, and it only peaked out at 12%. And since then, it's been getting worse and worse. And now we're down to 3%. So they're barely making any money. Like, you might as well, like, I can earn more money just keeping my money in the Robinhood Gold account, and I earn 5% per year. So why would I want to put my money with this company or this business who's only making 3% per year? It's almost like a waste. So that's something to take into consideration. because normally you shouldn't expect to get too much more from your investment than what the company's getting on their investment, right? Growing equity, this is a lot. This is a little bit better. We're looking at equity of, if we go back the last couple of years, we can see 41 billion, and now we're up to over 50 billion. So that's good. They are doing a good job with that. Then we look at the equity, it's nearly half of the market cap now. So that's actually good because the market cap is about 106-7 billion and the equity is a little bit over 50 billion, right? So that's good. Share count decrease, nope, it's been increasing at about 1% per year. So not really, that's not bad, but it's not good. The assets compared to liabilities are definitely not double, but it's not a bad ratio. 168 to 113. That's not that bad. I've seen a lot worse. Profit margin over 10%. This one gets a check. I was actually surprised because a lot of times there's a correlation between margins and their return on capital numbers. But this is not bad. A bottom line margin of 15%. That's not bad. There's a lot of companies out there that have a lot worse margins, so that's not bad. Cash and receivables, nearly 6 billion, which is about double their average income. With that being said, they've been doing the same amount of income nearly for 10 years. So, I mean, they've had some time to stack up the balance sheet. Healthy dividend, yes. 44% payout ratio is definitely healthy, and they're growing at about 11% per year. So that's solid. That's good. And the dividend yield on this one is, I believe, 3.5 or 3%. Yeah. And the company is almost 100 years old, and then the free cash flow is not good. This is another really bad sign. It's been negative for 4 years now, and it used to be positive. So it's getting worse because, so let's go to adjusted cash flow for stock-based compensation. 2018, they had a great year, their best year ever, $4.6 billion of free cash flow. And since then, they're doing negative $2 billion nearly, or negative 1.5. So that's not good. Although this is probably a very solid, I don't know if I should say solid business model, but maybe a solid moat for the space they're in, like where they're operating in Florida and everything. It's not like this is an easy business to take over. So that could be a moat going for them, but at the same time, the return on capital is so bad and their net income is flat. It's not growing. The free cash flow is negative. So overall, I'm just really not a fan of this stock, and even though it's down big, I would not be buying it. Even look at the 5-year chart here. We just, after today, this pretty much kills any gains the stock has made in the last 3.5 years. So we're back to 2020 and 2019 levels of where the stock is trading. So from that perspective, it looks like a better opportunity to get in if you're interested in investing for some reason. Maybe you think this is going to come back. But yeah, for me, I'm not really interested in this. I'm looking at the things that are important to me are the return on capital numbers, and they just don't have that. So thank you for watching. I will see you in the next video.